Right now, your 1,000 peso weekly habit is, it's directly funding the global artificial intelligence arms race.
Yeah, it really is.
Welcome to today's deep dive. We aren't looking at, abstract market trends today or some theoretical financial advice.
Right, no textbook stuff today.
Exactly. We are looking at your actual portfolio. We have your personal investment data, and we're going to cross-reference it with the strategic playbooks, the marketing literature, and the legal fine print of the massive institutions currently managing your money.
We're talking ATRAM, Manulife, and the Trust Officers Association of the Philippines.
Right.
Because today we are dissecting how your individual disciplined micro habit, that weekly 1,000 pesos, actually intersects with the macroeconomic machine.
Which is a huge shift, right? Because when you map a really specific personal strategy against the underlying mechanics of global finance, you stop being a passive consumer of financial product.
Right, you become a strategic capital allocator.
Yes. So let's define the baseline here. So the underlying logic is clear for everyone. You began this specific journey on January 7th, 2026.
Ooh, great time to start, honestly.
For sure. And your strategy, it's relentless in its discipline. You take 1,000 pesos every single week, and you rotate it sequentially across 4 specific unit investment trust funds, or UITFs.
So just to break that down, week 1 goes to Fund A, week 2 goes to Fund B, and so on.
Right, exactly. And when you have surplus cash, you double the input. But crucially, your timeline is structurally divided into 2 distinct phases.
Yeah, this is the really interesting part of the architects.
I know, right? It's a 3-year accumulation phase where you're constantly buying in, followed immediately by a 3-year passive holding phase where you just let the assets sit there.
And that 6-year horizon is the framework we really need to analyze today.
Okay, let's unpack this.
Because before we even evaluate the specific assets you're purchasing, the mechanics of how you are acquiring them, it warrants a really close look.
Oh, absolutely.
This weekly rotating injection of capital, that is the exact behavior the Philippine financial industry is currently engineering its platforms to capture.
Yeah, I was looking at the Trust Officers Association of the Philippines, or TOAP.
Yes.
They have oriented their entire public-facing resource center toward this exact demographic. Their primary campaign right now is just aggressive myth-busting.
What kind of myths?
Well, the TOAP website features this article prominently titled, How to Start Investing with P10,000, alongside pieces like Spend, Save, or Invest, What to Do with Your Dollars.
Oh, right. So they're targeting the entry-level mindset.
Exactly. They are systematically trying to dismantle this psychological barrier that investing requires, like a massive lump sum of wealth just to get a seat at the table.
Which is so important because they recognize that the barrier to entry is no longer technological. It's behavioral.
Wow, yeah, that's a great way to put it.
The infrastructure to process micro-investments, like your weekly 1,000 pesos, it already exists. Manulife is pushing these digital access platforms like IFENDS to eliminate the friction of visiting a physical bank branch.
Nobody wants to wait in line at a bank anymore.
Exactly. And ATRAM is leveraging over 460.5 billion pesos in assets under management to open up international markets.
That is a staggering amount of money.
It is. The institutions have the plumbing in place, essentially. They just need the retail investor to turn on the faucet.
Okay, but we need to look closely at that plumbing, though.
Right.
Because you're buying into UITFs that are specifically labeled as feeder funds. Your portfolio includes the ATRAM Global Technology Feeder Fund and the Manulife Global REIT Feeder Fund.
Which sounds incredibly fancy.
It does. The marketing makes it sound like you, with your 1,000 pesos, are buying directly into global tech companies. But a feeder fund implies a completely different mechanical structure, doesn't it?
It really does. What's fascinating here is that the mechanism of feeder fund is this brilliant workaround for the limitations of retail capital.
How so?
Well, think about it. If you take your 1,000 pesos and try to directly buy shares of a semiconductor manufacturer in Taiwan, or an infrastructure project in Europe.
Right.
The international brokerage fees, the currency conversion spreads, the wire costs, all of that would completely consume your capital before a single share was even purchased.
So you'd be at zero before you even started.
Exactly. Yeah. The math of micro-investing on a global scale simply does not work for an individual.
So it's kind of like a gym membership, right? Investing isn't this exclusive country club anymore. The local institution acts as an aggregator.
That's a perfect analogy.
So ATRAM or Manulife takes your 1,000 pesos, pools it with tens of thousands of other retail investors locally. converts that massive pool of pesos into dollars or euros at an institutional rate, and then feeds it into a massive global target fund.
Right, the master fund, which is usually located offshore.
So your local pesos are basically buying local units of this massive international block.
Yes. The mechanical advantage there is absolute scale. The master fund managers in New York or London, they do not want to deal with 1 million individual accounts holding a few dollars each.
Obviously not. That would be a logistical nightmare.
Right. They want a single, massive wire transfer of $50 million from a local entity like ATRAM. So by pooling your funds, the local institution gets their management fee, and you get institutional-level access and diversification.
Stuff that used to be strictly walled off from the average retail investor.
Exactly.
Well, that structural access is clearly paying off for you.
Yeah.
Let's look at your actual deployment of capital here.
Yes, let's look at the numbers.
Because based on your May 21st, 2026 data, one of your deployments is entirely separating itself from the pack.
The tech fund.
Oh yeah, your ATRAM Global Technology Feeder Fund has a total actual investment of 5,000 pesos, but the current market value, 5,725 pesos and 10 centavos. Yeah, that is a massive proportional gain in less than 5 months.
It is, but you have to understand why. The underlying assets within that technology fund are driving the broader global market right now.
Oh, for sure.
ATRAM and Manulife are entirely synchronized in their assessment of this sector. I mean, in February 2025, ATRAM launched their Global Artificial Intelligence Feeder Fund, which was the first in the Philippine market, by the way.
And how did they justify that?
They literally called AI the disruption of a lifetime.
The disruption of a lifetime. That is strong marketing copy.
Right. And Manulife's literature on their Global Semiconductor Opportunities Equity Feeder Fund echoes that exact same structural reliance.
Yeah, I read that. They just strip away all the technical jargon and state it as an absolute macroeconomic reality. They say, the world runs on chips, now your investments can too.
Because it's true. They are highlighting a vital supply chain reality. AI is the software revolution, right? But semiconductors, the chips, they are the physical hardware constraint.
Right, you can't have one without the other.
Exactly. You cannot build a predictive language model or automate a global logistics network without massive, specialized silicon processors.
So it's the engine of the sports car.
Yes. The companies designing and fabricating these chips are currently experiencing a historic demand squeeze.
Which directly translates into the aggressive capital growth we are seeing in your portfolio data.
Precisely.
Here's where it gets really interesting, though. I have to push back a little on this.
Okay, go ahead.
ATRAM calls this the disruption of a lifetime. But historically, chasing disruptive tech is a complete roller coaster.
Oh, absolutely.
I mean, look at the dot-com bubble or the cyclical crashes in early cloud computing infrastructure. The very nature of disruption means current market leaders can be rendered obsolete overnight by a new algorithmic breakthrough.
It's high risk, high reward.
Right. So how much disruption can a carefully planned 6-year portfolio actually survive before that volatility just drags the entire accumulated value down?
Well, if we connect this to the bigger picture, the systemic risk of the technology sector is precisely why a concentrated tech-only portfolio is a failure of structural design.
So you shouldn't go all in on the tech engine.
Definitely not. The rapid innovation that generates your 700 peso gain is the exact same force that can cause a 40% drawdown in a single quarter.
Wow. Just from what, like a regulatory hurdle being announced in the US or Europe?
Exactly. And if your entire portfolio is subjected to that level of volatility drag, the mathematical effort required to simply recover your initial capital becomes exponential.
Which brings us to the architecture of the rest of your portfolio.
The stabilizers.
Yes. Looking at the composition of your 4 funds, the strategy isn't built to be a rocket ship. It's built like a suspension bridge.
Oh, I like that.
Yeah, so the tech fund is the high-speed traffic moving at 100 miles per hour across the span. But your other 3 funds, the ATRAM Global Infrastructure Equity Feeder Fund, the Manulife Asia Pacific REIT Fund of Funds, and the Manulife Global REIT Feeder Fund. These are the massive steel cables buried deep in bedrock. They exist to keep the whole structure from tearing itself apart in the wind.
That structural metaphor maps perfectly to how these assets function on a balance sheet, actually.
Oh, really?
Yeah. Manulife deliberately segregates their offerings. The semiconductor fund is categorized strictly for capital growth.
Right, the engine.
But your real estate investment trusts, or REITs, and your infrastructure funds, those are categorized as income-paying and low volatility.
So what does this all mean when we look at the numbers, because the contrast in your portfolio is stark.
Let's hear it.
Your actual investment in each of these stabilizing funds is the same 5,000 pesos as the tech fund.
Right, because of the sequential weekly rotation.
Exactly. But your current values are vastly different. The ATRAM infrastructure fund is at 5,208 pesos and 66 centavos. Manulife Asia Pacific REIT is at 5,115 pesos and 80 centavos. And the global REIT is at 5,209 pesos and 30 centavos.
So they are up, but just slightly.
Right. And human nature dictates a desire to optimize. It is incredibly tempting to look at a fund yielding a 115 peso gain, cut it loose, and redirect that weekly 1,000 pesos into the tech fund that's yielding over 700.
Oh, I'm sure it's tempting. But abandoning the stabilizers during a growth cycle is a classic behavioral error.
It's like refusing to eat your vegetables so you can just have the tech dessert.
Exactly. And doing that leaves an investor entirely exposed to systemic shocks. We have to look at the underlying mechanics of what a REIT and an infrastructure fund actually own.
Okay, what do they own?
They own tangible, physically constrained assets. A REIT owns commercial office buildings, logistics warehouses, healthcare facilities.
Real physical concrete and steel.
Yes. And an infrastructure fund owns toll roads, municipal water systems, telecommunication towers.
It's the physical foundation that the digital economy actually requires to exist.
Right. I mean, an artificial intelligence company still needs a massive temperature-controlled data center to house its servers.
Right.
And that data center has to be powered by a heavily regulated municipal utility grid so they can sell digital products to employees working in a commercially leased office building.
Everything is connected.
Everything. And the financial behavior of these physical assets provides the necessary counterweight to tech volatility.
How so?
Well, commercial real estate and infrastructure operate on long-term, multi-year leases and government-regulated utility contracts.
So it's steady.
Exactly. This generates highly predictable, recurring cash flows. While the valuation of a semiconductor company might swing wildly based on next quarter's projected earnings, the toll road continues to collect daily fees regardless of market sentiment.
They absorb the shock.
Exactly. They are the shock absorbers.
So if the tech sector experiences a massive correction, the steady dividend yields and predictable valuations of your real estate and infrastructure funds act as a floor.
Yes, preventing the total value of your portfolio from cratering.
So you are actively buying structural integrity with those other funds.
That's a great way to summarize it.
But, having the right assets is only half the equation.
What's the other half?
The timeline. We need to evaluate your specific 6-year horizon against the unvarnished reality of the corporate literature.
Oh, right. The fine print.
Yes. Because Manulife, for example, spends millions engineering a brand identity around long-term stability.
They do. They publish thematic insights like #FYP, future-proofing young Pinoys.
Right, and articles exploring why younger demographics need immediate retirement planning.
They package their products under these really reassuring banners like Goal Ready and Wealth Own.
Right, the overarching narrative is one of a managed, highly curated journey toward financial independence. It feels very safe.
It does feel safe.
But that glossy narrative collides violently with the legal firewall buried at the bottom of their platform.
It always does.
I mean, the legal disclaimer for these UITFs explicitly states that they are not deposit products and are not insured by the Philippine Deposit Insurance Corporation.
No PDIC insurance.
None. The text aggressively warns that there are no guaranteed returns, that the value of funds may fluctuate, and that capital can be completely lost due to market volatility.
Completely lost. That's the part people skip over.
Yeah. Furthermore, Manulife explicitly states they are not liable for losses arising from market fluctuations.
So they are legally shifting the burden of systemic macroeconomic risk entirely onto you.
Exactly. And there is a huge cognitive dissonance between this goal-ready marketing and a massive wall of legal text saying you could lose it all.
This raises an important question, though. How do you square your 6-year plan with this unvarnished reality?
Right.
Well, the cognitive dissonance is actually a necessary feature of modern financial markets. The institution is providing the vehicle. They are not guaranteeing the weather.
Okay, that makes sense. So if the institutions are washing their hands of the risk, then your specific 3-year accumulation phase isn't just a savings goal.
No, it's not.
It is a mathematical defense mechanism against that exact volatility.
Exactly. Because when you commit to investing 1,000 pesos every single week, regardless of whether the market is up or down, you are utilizing peso cost averaging.
Okay, let's break down the actual mathematics of peso cost averaging, because from what I understand, it actively turns volatility from a threat into an advantage.
It really does. So let's say the unit price of your tech fund is 100 pesos. Your scheduled weekly 1,000 peso injection buys you 10 units.
Simple enough.
Right. But if a market shock occurs, the weather gets bad, and the unit price crashes to 50 pesos.
Your same 1,000 pesos automatically buys you 20 units.
Exactly. The fixed peso amount mathematically forces you to buy more units when the asset is cheap and fewer units when the asset is expensive.
So over your 3-year accumulation phase, this mechanical reality actively drags your average cost per unit down?
Yes. You don't have to predict the bottom of a market crash.
Because your automated habit basically exploits the crash for you.
Exactly right.
Wow. And then, crucially, you transition into the second half of your strategy.
The holding phase.
Right, the 3-year holding phase. You cease the weekly inputs, but you leave the accumulated assets in the market.
Because time is the ultimate neutralizer of the volatility drag warned about in those PDIC disclaimers.
Time heals all market wounds.
Usually, yes. A 3-year passive holding period provides the fundamental runway for the underlying assets to actually execute their business plans.
Right, it gives the semiconductor plants time to build new fabrication facilities.
And it gives the commercial real estate trusts time to renegotiate higher inflation-adjusted leases.
You are giving the seed enough time in the ground to actually become a tree, completely ignoring the day-to-day weather patterns above the soil.
That is the goal, yes.
So when we pull back and look at the entirety of this strategy, the elegance is really in how tightly the microactions align with the macro realities.
It's very well designed.
You're perfectly utilizing the democratized access praised by the TOEP. You're exploiting the mechanical advantages of feeder funds to deploy capital globally alongside institutions managing hundreds of billions of pesos.
You have essentially constructed a highly resilient portfolio bridge.
Right. Anchored by the physical realities of infrastructure and real estate.
While still capturing the aggressive upside of the AI and semiconductor revolution.
And you've wrapped it all in a 6-year, mathematically defensive timeline that respects the inherent legal risks of UITFs.
It is a rigorously constructed approach to capital allocation in a highly complex 2026 economic landscape. The logic is sound, and the current data validates the architecture.
The architecture is sound for the world as it exists today, sure.
Right.
But, part of a deep dive is examining the blind spots.
We always have to look for the blind spots.
And your strategy relies heavily on that secondary 3-year phase, the passive holding period where you essentially just set it and forget it.
Yes, and the fundamental assumption of a passive holding period is that the underlying nature of the market will remain relatively consistent.
But wait. Your primary growth engine is the artificial intelligence and semiconductor sector. And ATRAM themselves define this as the disruption of a lifetime. By its very definition, hyper-accelerated technological evolution does not respect a passive timeline.
No, it absolutely does not. The pace of change in artificial intelligence is currently measured in months, not years.
So the companies driving your tech fund today might be rendered structurally obsolete by a new paradigm of quantum computing or even biological processing by the time your holding phase even begins.
It's entirely possible, which leaves you with a critical variable to consider as you execute this strategy over the coming years.
That's it.
Will a rigid, passive, set-and-forget holding strategy actually survive the turbulence of the next 6 years intact?
Wow.
Or will the volatile, hyper-disruptive nature of the very technology you are funding force you to actively manage, adapt, and restructure this portfolio long before your timeline is complete?
It is the ultimate paradox of investing in disruption, isn't it?
It really is.
You are betting on the rapid transformation of the global economy, but you're using a strategy built on the assumption of long-term consistency.
The rules of the country club might be changing faster than anyone anticipated.
Definitely something to heavily scrutinize the next time you drop that 1,000 pesos into the machine.